Welcome to I Call Bullshit Property Podcast, where we separate real estate fact from fiction. I'm Reece, and in every episode we uncover the truth behind the property market's biggest claims and trends. Joining me is our resident expert, Lachlan and Reece. He's seen it all, and he isn't afraid to call the bullshit when he sees it. Welcome, Lockie.
Thanks, Reece. Let's crack on.
All right, let's jump into the first topic. Cash rate decreases will help people get into the property market. So looking at a few articles, we've got news.com.au. CommBank predicts FOMO will leave house prices up at the end of the year despite the rate cuts. Australian Property Update has property markets set to take off after RBA rate cuts. And AFRA home loan demand rises as buyer rate for rate cut. So I guess the first question is, we've had our first cash rate decrease in some time and for the year. And, many experts are predicting there's going to be multiple over 2025. How does that cash rate help serviceability?
So the 0.25% cut that we just had recently, depending on independent situations, is going to give an increased serviceability of 3 up to 5%. So someone who's going out there that was capped out at $1 million can now buy a property up to $1,050,000. So in that scenario, it increases serviceability by about $50,000. If that is to continue at the rate that's been forecasted, and depending on which paper you read, there's forecast of 3, potentially 4 rate cuts at 25 basis points a pop. That would put us in a position where we've seen a full % rate cut potentially by the end of the year. Not saying that's going to happen, certainly not what I think is going to happen, but that's what some of these media outlets are reporting. On that basis, it would increase serviceability between 15 and 20%, which is significant. So that same scenario that we spoke about, when you capped out at $1 million, that now goes to 1.2. So that's sort of the threshold that we're talking about.
I was doom scrolling on LinkedIn recently, and I saw a mortgage broker say, with the 0.25% decrease, that would reduce a $500K loan by $80 a month.
Yep.
And if you paid the similar repayment that you were paying before, it could actually reduce your loan term by 2 years. So,
We'll net that out on a full percent, and you're looking at 8 years. That is significant.
Correct. And I think it's not everyone is going to be in that situation where they can't afford that repayment, and actually the rate decreases are there to provide some relief. But I thought that was some good antidote for those that maybe have had a good history of paying the higher repayment and have got used to that, and actually maybe the cash rate could actually be beneficial. Well, cash rate is going to be beneficial, but could actually pay their home loan off quicker.
Yeah, definitely. And I think what we fail to see here in Perth is that we've had a very, prosperous market over the last 5 years. So people have invested in property and it's gone up in value, therefore your equity position's improved. So albeit it's costing you more to hold that property, there's constantly a good news story about, you go to the bank or they do a desktop valuation, it gets refinanced. It's a positive news story, right? Your investment is making you money. People don't understand here in Perth, and obviously we've got family in Victoria and colleagues and family in Sydney. A lot of these people got caught out and they bought properties at the top of the cycles in Victoria and Sydney and New South Wales in general. At the peak of COVID, 2021, 2022, when interest rates and cost of money was extremely cheap. Now we're talking 2.5%, 3%, and paid big dollars and took advantage of the cheap money at the time. Fast track to 2025, the properties that they paid, $1.5, $2, $2.5, $3 million for, are now down anywhere from 10 to 30%. And we're talking, some markets across parts of Victoria and New South Wales have dropped as much as 30%. There's evidence to suggest that. And the cost of money has gone from 2.5, 3% to 6.5%. These people are in a lot of pain and a lot of stress. So, albeit there's two ways to look at it. It increases serviceability, means people's borrowing capacity goes up. So locally here in Perth, we'll probably see that into the market. Over on the East Coast, it's a different story. People are forced selling at a loss. There's a lot of really tough stories out there for people in the East Coast markets. People here in Perth, they had 10 years of positive growth. We shouldn't feel sorry for them. But for those who only entered the market late, it's certainly been tough.
Do you think those people over East, as you mentioned, property market's been on gangbusters over there for the last 10 years. Do you think the ones that maybe have felt the brunt of the rate increases were overexposed? So, in a previous life, I worked for a bank that supported people that had maybe some adverse credit in the past. And the data that we used to track was actually first-time buyers had the lowest delinquency rate out of any of our borrowers because they were generally at the start of their journey.
Bit more conservative.
You know, they're going to have their income's going to increase over the next sort of 5, 10, 15 years. So, you know, looking at maybe where people are starting to feel it at the moment, do you think it is people maybe that are overexposed that maybe got their investment properties or maybe shot for the stars for a property that was maybe out of their reach at the time?
Yeah, that's exactly what we're seeing in Perth now, right? So you've when a market goes through a run like we're seeing here in Perth, everyone's an expert. Go to your barber, he'll tell you where to invest. Jump in a taxi or an Uber, he'll tell you he's bought a property out in a suburb you've never even heard before and he's made 40 or 50% in 2 years. So that confidence just breathes more confidence, and that's exactly right. It's what we saw in Victoria and New South Wales. 8 years of positive growth. No one can lose money in property, right? That's the sentiment. So that sort of, you know, conservative, risk-averse attitude of this is the biggest financial decision you're going to make. Maybe we should be a little bit more cautious. Maybe we should speak to an expert. Maybe we should, you know, be a little bit more probably hesitant rather than just jumping in. But when you have that level of growth, everyone's making money. It's completely de-risked. So the people, you know, from a mindset point of view, so people are just jumping in, buying one, which was a positive experience. They made 50% in a short period of time. Buy a second, quick 20, 30%. And they're like, well, this is too easy. I've just got to buy more properties. How can I get more debt? How can I get more equity? And all of a sudden, they overexpose themselves late in the cycle. And that's what we saw in these East Coast markets.
I mean, it's a good point you make. It's as far as everyone's talking about property, everyone's making money, everyone's talking about rates now.
Everyone's got a podcast.
You know, I would have friends come to me over the years just with my background and ask me questions. Now I can't get a word in. I just let them go because everyone's got an opinion. Everyone's making money on property. Everyone wants to talk property. Everyone's talking investments. Everyone's talking about rates now. So I think, you know, the sentiment, especially like isolating Perth, obviously, other markets have been on a run for a while now. But I think people in Perth now are very conscious on rates and love to talk about the success on properties as well, I think.
Yeah, and we're going to see that because, like I said, I still think the market's got plenty of legs. So I just think people want to be more cautious at back end of the cycle. I'm not saying we're at the back end of the cycle here in Perth. I don't think we are, but just not getting caught into the same trap that we saw what happened in Sydney and Melbourne, you know, that through that COVID buzz and hype. But it's try not to listen. My advice to the listeners, here today is try to, you know, only take advice from experts or people who have done this religiously through cycles, not just one cycle, not just this cycle, but people who have been and seen, you know, boom and bust. They've been countercyclical, meaning they've invested in other markets around Australia, because regardless, markets around the world, and particularly in Australia, follow a very consistent cycle. And that's typically 7 to 10 years of growth, followed by 4 to 6 years of stagnation. That's what history has told us in Australia for the last 100 years. That's our markets. And there's obviously exceptions to the rule, but across the board, each market is operated in the same context and the same cycle. So with that in mind, you know, Perth at the moment, we're arguably in our fifth year or fourth to going into our fifth year of growth. Still, you know, quite modest, probably 9 o'clock if you looked at that at a property clock in terms of where we are on a timing point of view. You know, and we look at Sydney, that went for its full run of, you know, just over 10 years of growth. So just got to look at that and take that into context and learn from mistakes others have made in other markets.
And just going back to what we saw in February with the 0.25% drop, how did that affect the property market?
Perth locally, we've seen the highest amount of sales that we've seen since 2023. So there was 1,056 sales within that following week. So, you know, is that a coincidence? I don't think so, because it breathes sentiment. So we saw an immediate impact in terms of demand into the market.
And it's the commentary leading up to it as well, I think.
Exactly.
Since December, the commentary's been amping up about cash rate decreases, and I think that kind of spits balls before we even see the drop as well.
Yeah, I think the sentiment around it and the commentary around it does more to the market than the cut itself. It only really just confirms what the markets believe was going to happen. So, and now I believe markets, albeit we're coming up to an election, so what you may see over the next, you know, 30 to 60 days is some stagnation in the market because there's a national election. No matter which period of time when we look back, there's always typically a stagnation in the market as we lead up to these major events. So we may not see the same level of activity as we did following the rate cut, but post that and potentially throw another rate cut on the back end of that election, and depending which way it goes, whether it's Liberal, which is very pro-property, very anti-negative gearing reforms, very much looking to make banking policy deregulated in some aspects, versus a Labor government that's certainly aligned with the Greens around getting rid of negative gearing and those sorts of things. That could have a huge play on.
We could have a whole podcast.
We are going to have a podcast on
gearing, I think.
Yeah. But that will have an impact on sentiment as well.
Yeah, and I guess in terms of, sort of touched on that briefly, but are there better ways the Reserve Bank can support the people into the market, particularly first-time buyers?
That's a podcast on itself, Reece. I think there's so many reforms, stamp duty reforms, that we need to look at to help those that can't get in there. The hardest thing to get into the market is a deposit, right? So I think the way they're going with reducing the stamp duty or increasing the stamp duty exemption point, so that locally in Perth, that's been increased to allow the exemption for stamp duty. I think that's a positive way, because that's it's an out-of-pocket expense, typically not wrapped up in the loan. And getting some deposit relief. And there's been a lot happening in this place. Obviously, not everyone can rely on the bank of mum and dad. So the government are providing support to help with that deposit, because that is the hardest thing to get into the market, as we've discussed previously.
Yeah. And I mean, reflecting on some of the earlier conversation in terms of the difference in repayments or the percentage increase or decrease it helps from a rate cut. And then you've obviously mentioned the buyer sentiment increasing. Feels like I know where the answer's going. There's other tools I think we can use outside grants and outside the RBA with announcement. Serviceability buffers are a big talking point amongst banks and lenders in Australia, and APRA has a 3% buffer at the moment, which covers any of those.
Which is crazy to think, right? It's particularly when interest rates are at 6.5%. They're getting assessed on 9.5%.
Yeah.
This is your space, Reece. You know it better than any, because this is your background. Is that just a joke? And where would an appropriate amount, threshold be?
And the thing is, they've been flexible with these buffers before, so it's not set in stone that it hasn't been amended in the past. If we do see ourselves now in a decreasing rate environment, have we hit the peak of this cycle? And do we now look to drop that serviceability buffer down to 2%? 12 months ago, the UK had a similar process, and they weren't even in a decreasing environment. They were in a period of stagnation with their equivalent of the RBA, and they decreased it down to 2%. So, yeah, definitely feels there has been a lot of talk in the media, especially towards the back end of last year, regarding the serviceability buffer. But it does feel like if we have a lot of economists out there at the moment predicting there's going to be multiple rate cuts this year. We've had one in February already. I think it's time to start to look at that, and that will show some real impact. And we could even maybe look to tailor those solutions. So if we certain type of client to help them get into the market, whether there's an
exemption for different clients,
correct,
type investors. Because what it will do is, you think if we were to see hypothetically with the end of 2025 and we saw a 4% rate cut, 4 rate cuts at 25 basis points apiece, and we saw the serviceability buffer come down from 3% to 2%, that is significant. We're talking your borrowing capacity would increase in some situations up to 40%. Yeah. So what do you think happens to the market?
Yeah. But that's the crazy thing. It's like, what happens to the property market?
Of course it does. That gets all these gains from serviceability are realised in property prices. Yeah. So all it's going to do in turn is going to put more fuel on the fire, and we're going to see further price growth or price inflation. So I think what you've discussed there of tailoring the serviceability buffer to those who probably need it more than others. Otherwise, we're just going to see the flow-on effect, which is great for investors, great for people that are already in the market, but it's going to make it more challenging for those trying to get into the market in the future.
Correct. If there's some sort of reform on that, or as you were mentioning earlier, if we start reviewing some of these other first home buyer schemes, and we discuss that can be another episode altogether in terms of
stamp
what
duty
grants,
exemption for those, like the stamp duty is a terrible tax, right? Particularly for those who are going through situations, say a divorce, then you then get penalised to then enter back into the market. These are specific cases, individualised cases that should be identified in isolation.
Yep. So Lachlan, what's the verdict? Cash rate decreases will help people get into the property market. Fact or fiction? Do you call bullshit?
In isolation, I call bullshit. I don't think it will help people get into the market. I think it will actually make it more challenging because it's only going to add to price growth into the market and therefore make it more unattainable for those new entrants.
Make sure to join us next episode. Stay informed, stay curious, and keep calling out bullshit.